Good morning, good evening, good night, wherever you're watching this transmission. 'Tis I, Mike Martins, your humble servant, bringing you a very, very important message from the Financial Review from down under in Sydney. And if you're living in the Northern Hemisphere, don't click this off, because everything that's happening in every single English-speaking country is all, for some reason, they're all connected. It's all connected in the UK, New Zealand, Canada, United States. Well, west coast of the United States. It's like this huge global disaster. And my money is on Australia to fall first, more than any other country, and send enough reverberation through the rest of the English-speaking world to put us into a huge paradigm shift that, and who knows, right? But I just got my feeling on Australia. That's why I've been following it for many years. A sharp fall in house prices should not trouble mortgage bond investors, but further price declines in Sydney and Melbourne are likely, according to securitisation analysts, have tracked the house prices relative to the earning of full-time workers. And it's been many years I've been talking about, like, there's something wrong and it's going down under. And then it started I noticed it first in Vancouver. Then I started seeing the patterns coming from Australia. And then the patterns I started noticing were pretty big. And this is when I started noticing it here. Let me lower this here. Right here. This article I did here. This article, I got this. Somebody actually downloaded my videos. In 2000, so Sydney, Vancouver housing crash of 47% by 2016. So this was in 2015. I was noticing at the beginning of 2015 that a lot of things just did not add up. Wages and incomes and all this stuff didn't add up. And at the back of my mind, the whole time I'm making these videos, is I know interest rates have to go up. We've artificially lowered interest rates. I don't know. We've never done it before, and we've done it now. And in 2015, I'm saying, wow, this is going to be pretty bad. Then they went to lower rates again, and then lower rates again. And obviously, assets go up because of this artificial inflation, this bubble that we created. And it was this time when I started introducing Sydney with Vancouver. And that was in 2015, and I knew something was not right. And a lot of people say, oh yeah, Mike, you can keep predicting the housing crash for 10 years in a row, and eventually you'll be right. No, but it's not that. This is very different. This is not normal. This is beyond normal, okay? And it was very important that I got my message out. Then Canada, UK, Australia, New Zealand. Oh, here it is, November 11, 2015. Canada, UK, Australia, New Zealand debt prison. You know, for people that have been following my channel, they know this stuff, right? They know I've been doing this supply versus demand and illusion in 2016. So a lot of this stuff but somebody working in an industry, I don't care what they do, but don't they realize that they can't afford something when they can't buy it? That's what I'm trying to get at here. Like, basic grade 2 level. I have $2, and do I buy A, 2 apples for $2, or do I buy B, 30 apples for $12? Well, I'll just buy the 30 apples and hope to sell them off, and then hopefully recoup the money I'm negative in. That's exactly what's happening here, but it's worse, because when you buy a house, it's your biggest asset you'll ever own. So track the housing prices relative to earnings of full-time workers. The analysis prepared by National Australia Bank corporate finance staff for clients showed that while nationwide house prices were in line with average multiples of full-time earnings, Sydney and Melbourne prices would need to fall further to correct what is considered an average level. With price earnings multiple in major Sydney and Melbourne markets still above their 10-year averages and comfortably above their bottom 25% quartile levels. It's not quarterly, guys. It's quartile. Yeah, it's quarterly. Holy crap. It's spelled different than we do it, but it's okay. Further declines should probably be expected, National Australia Bank Director Ken Hanton said in a note to clients. However, there is still some way to go before these multiples fall aside. The ranges have existed in the post-global financial crisis period. Ooh, 3 free months internet. The residential mortgage-backed securities market, in which home loans are packaged up in trusts and sold to fixed income investors, is a vital source of financing for non-bank and regional lenders, but it also tapped occasionally by the major banks. Oh God, this is like Europe buying back its own debt. Oh, this is going to be an absolute disaster. Remember what happened with Freddie Mae and Bernie Mac selling mortgage-backed securities, and people even betting on some of them to fail? People are actually hedging against them to fail, and people buying them bad debt and good debt. Why would they do this? Why would they sell out like this? While RMBS funding costs have fluctuated over the last 10 years, the assets backing the bonds have performed strongly as arrears have remained low. Investors in Australian RMBS have yet to experience a loss of capital, and while CoreLogic data shows house prices have fallen by the fastest pace in over 10 years, NAB analysts still see no reason to be concerned. These guys have to be out of their mind, like absolutely out of their tree. With capital outflows at China at pretty much zilch, and watch China in the next 6 months to a year saying, you got to bring your wealth back home, or something's going to happen. Watch. That is because the price in major cities would still need to fall significantly relative to earnings to hit levels experienced during the global financial crisis, where mortgage bonds held up. On a nationwide basis, NAB said dwellings are valued at multiple of 5.8 times annualized weekly full-time earnings. That is actually below the 5 and 10-year average measure, but above the 20-year average of 5.5 times. Wow. So here is the stratified median capital city prices in hundreds. So that's 800, 750, 600, 625, 44,000. And wow. It's just too high. It was high back when I was making these videos in 2016. You're not supposed to work your entire life just to pay a mortgage fractionally down. You should be able to pay your house off in 10 years. It's not, well, we'll fractionally have it down to 60%, and then we'll have 40% left on our mortgage, and then we could sell it and then have a little nest egg. And that's not going to work. Not anymore. Okay, if you can get it down to 40%, that's fine. But you're not even going to get it down 10% when you have to keep refinancing every 4 years, 5 years when your term is up. You got a 30-year AM, 40-year, 35, 40, whatever. Interest only, whatever you're doing. And then with interest only, you're hedging against the prices do go up continuously. And if they don't, and you're paying interest only, you're automatically underwater. Sydney properties, however, remain slightly expensive on the measure, with the median sale prices currently 8.6 times the annualized weekly full-time earnings for North New South Wales workers. So here it is, 8.6 times. It should be 4 times. It should be 4 times. 3.5, 4 times. Remember that article I was reading in Chicago? People in fear in Chicago that now housing. The cost of housing is reaching 4 times the average income, and people are fleeing the city. And then I look at the average is like benchmark 210,000 for the house, and people are fleeing cities. Portland, Oregon, same thing in Portland, Oregon. Their houses reached 470,000. Mass exodus out of Oregon. A lot of people moved to Nevada and Salt Lake City, Utah. But you see, people move when things like this happen, right? And they go to where they could afford. So 8.5 times, significantly higher than the bottom quartile measure of 7.4 times. In other words, house prices have been below 7.4 times the earnings 25% of the time over the last 10 years. In Melbourne, the median sales price earnings multiple is 7.4 times, in line with the 5-year average, but above the 10-year average. 7.1 times, and well below the bottom quartile level of 6.6 times. House prices tend to bear a close relationship with earnings generated by workers in the region. Rising or falling incomes can either increase or reduce the ability to service a mortgage or pay higher rent. Yet, for 5 years, weekly full-time earnings adjusted for inflation have flatlined, while house prices have exhibited strong gains until mid-2017. This resulted in an increase in multiple house prices relative to earnings. In the 8 capital cities, the price-earnings ratio increased from 6.7 times in 2014 as high as 7.5 times before the retracting to 10-year average levels. Ooh, look at this in 2009. Unemployment rate. This is a good graph. This is actually a very good graph. It kind of coincides the unemployment rate and where it's at. This is a good graph because it gives you a good scope up until March 2019 here. And you got regional, national, and house price to earnings ratio. This is very good. So it's just too high. It's beyond what it should be, It should go back to 2004 levels, if you ask me. Maybe 2003, 2002 levels. Unless everyone gets a massive raise over the next couple of months and say, okay, guys, we're going to give you all a 40% increase in pay. Let's just keep things going as they are. We don't need to lower prices on homes and blah, blah, blah. Then I think a lot of people will be happy right across the board. But that won't be happening. And it goes back to what I was saying about this whole capitalism doesn't work because wages aren't catching up to inflation, and that's why the whole capitalism system doesn't work. Companies and corporations still keep making more money, and their books look better, but then the wages aren't catching up to the cost of living, and that's why capitalism is failing right now because of this, right? And I mean, there's got to be something that works, right? But that's definitely we're not getting the benefit of the doubt here, right? So in Sydney, the ratio reached as high as 10.5 times in June 2017 before retracting toward the 10-year average of 8.5 times. In Sydney, the ratio of median house prices sales fell to full-time earnings fell to 6.5 in 2009, at a time when mortgage rates were comparable to current levels and unemployment exceeded 6% versus 4% currently. So, I mean, they're trying to sugarcoat it, saying, well, we got more people working now. So what? They're not making any money. Here's your 5 capital cities here. And there's your national, and there's your combined regional. Dwelling price growth quarter over quarter. Meanwhile, in Melbourne, the property price earning ratio has been steadily rising 6 times. In March 2009, when the state unemployment was a rate about 6% versus 4.5%. So what? I get it, but it's still out of reach, beyond out of reach. More people working doesn't mean there's more affordability out there, right? What do you guys think? Anyways, we'll see what happens. I mean, I predict prices right now in Sydney will fall from what I've been seeing. Okay, here's the deal. If Australia rolls back rates to 0%, like 0% interest, zero, right across the board, they still couldn't get out of this right now. It's because Australia did what Canada did. They sold out to the highest bidding investor. Rich investors, and Australia, Canada, and the UK and New Zealand were competing for rich investors. Period. Plain and simple. Full stop. No debate. Now, we're reaping the damage now, and now we got to figure out how to replant this soil or replant this farm so we could get something blooming next year. If we don't, we're going to be in another rut, and it's going to keep going at least for another 4 to 6 years. It's just going to keep going down and going down and trickle down and trickle down and trickle down because there's an oversupply on the Sydney markets right now. Everyone's throwing everything on the markets. No one's showing up to those damn, what do you call those stupid things? When they go to those auctions. No, you go see the house. Let me get an environment inspection. Let me get a health inspector to check the place. Let me get the tested for mold. Let me get this. Let me get that. Let me get an electrician. Let me get a plumber to check everything out, make sure it's good, and then I'll give you an offer. Okay, how much you want for the house? $300. Okay, I pay for the inspections. I check. I'll give you $260. It needs this, this, and this. Take it or leave it. That's how it was before. Now, everyone stands out. Okay, I'll give you to the. How's the house? I mean, could we see? I mean, what's going on here? Anyways, guys, I just want to know what you guys think. Comment below. There's still a huge retraction that needs to be put together. Banks are not, and I repeat, will not raise rates. They just can't. They raise rates, and then affordability goes right out the window. And too many people borrowed more than they could chew, and then now it's coming. It's coming, and it's here. It's here. Comment below. Let me know what you guys think. I'd like to know in the comments below. And thanks for watching. And big hug to my friends down under in Australia. And don't forget to join me this Saturday night, my Saturday night, 9 p.m. West Coast time, West Coast Canada time, LA County time. For Mike in the Night, we'll be doing MGTOW, Men Going Their Own Way movement. What is going on? And add me on Skype and join the show. Thanks for watching, and have a good night.